After 3 straight years of these bull market surges, I mean, 25% one year, 26% the next, and another, what, 17% in 2025, can the U.S. stock market actually sustain this? Or is 2026, the inevitable pivot point?
That 3-year run has been pretty historic. And you're absolutely right. 2026 is shaping up to be a real watershed year.
A watershed year, how so?
Well, this is the moment the market really shifts from, let's call it concept speculation, the whole is AI real question, to the brute force reality of substantive execution.
Okay, so where the rubber meets the road.
Exactly. And that distinction is going to be brutal. It's going to rapidly separate the companies with viable, scalable, physical business models from those that are, just selling a great story.
So to unpack all this for you today has to separate that signal from the noise. We need to know, what is the steady foundational bedrock supporting the market next year? And then where is the real explosive breakout potential hiding?
I think to synthesize all your material, we can focus on two core components. First, we have a surprisingly stable and supportive macro and policy foundation. And second, there's the single primary market catalyst,
Yeah.
AI infrastructure.
Yeah.
And that is constrained entirely by resource supply.
Okay, let's start with that foundation because it really does set the whole table. The sources consistently suggest that the political and policy risk for 2026 is significantly lower and more predictable than what we've seen in years.
It is. And that predictability, it translates directly into cash flow
How?
through the Big American Act, which is by design very front-loaded and aggressive. This major policy package is all about targeted tax cuts, deregulation,
Yeah.
and it's built to concentrate its positive effects, specifically in the first half of 2026.
And we're not talking about some abstract trickle-down theory here. The analysis points to an immediate, tangible boost from resident tax refunds. These are targeted at low-income residents, averaging between, what, $1,000 to $2,000 per person.
Yes, and distributed early in the year, between January and April. The timing and the recipient there are key.
Right, because when you give a windfall like that to low-income groups, that money gets spent.
Immediately.
Yeah.
The economic multiplier effect is high and fast because those funds are much more likely to be spent right away on necessary goods and services.
So you get a rapid, measurable boost to consumption and consumer businesses right out of the gate in Q1.
Precisely. And the corporate side isn't lagging either. The act has a substantial $129 billion in corporate tax exemptions.
Aimed specifically at capital expenditure, CapEx, and R&D spending. So it's not a handout.
No, it's an incentive. It's designed to get companies to immediately invest in growth, in infrastructure. That money is meant to become actual profitability for capital-intensive companies.
I get the bullish take on stability, but, unremarkable can sound a little boring. Why should a sophisticated investor pay attention to a forecast that just predicts a lack of crisis? Where's the impetus for growth if everything is just steady?
That's the strategic twist the material highlights.
Yeah.
That stability isn't boring background noise. It is, strategically, the most valuable commodity for long-term investors.
Okay.
Look at the monetary side. The Fed is expected to do 2 interest rate cuts, probably March and July, aiming to reach that long-term 3% neutral rate.
And that 3% neutral rate, just for the listener, that's the critical target, right? It means the Fed is done tightening and is now just balancing the economy.
Exactly. It's not stimulating or restricting it aggressively. So when you combine that policy predictability, stable rates, low crisis risk, inflation coming down, it removes the uncertainty that paralyzes long-term investment.
So the stability itself is the catalyst.
The stability is the catalyst. It de-risks those multi-year growth plans. It justifies increasing capital allocation into high-growth, rate-sensitive projects.
That completely reframes the environment. The market's job isn't to guess the next Fed move, but to find where capital will flow now that the drag of high rates is gone.
It's prescriptive certainty. And it's why so many reports are bullish on, say, smaller capitalization securities in sectors like biotech. Small caps often have higher debt, so they're super sensitive to rates.
So stable, falling rates just remove that massive headwind for them.
Right. They can finance growth aggressively again. A financial firm, for instance, noted that small cap companies contributed the majority of novel drug approvals recently. The certainty of cheaper capital just supports their long R&D timelines.
Well, what about the risks still hanging over the macro picture? I'm thinking labor and inflation. Aren't we seeing unemployment tick up?
We are, but the risk there is low and I think often misunderstood. The rate is projected to trend upward, maybe hitting a high of 4.6%.
which sounds bad on the surface.
It does. But the analysis shows the mass layoff rate is still historically low, around 1.2%. This suggests the rise in unemployment is less about companies firing people and more about increased labor supply, people coming back into the market.
Which is a much healthier economic signal.
A fundamentally healthier signal. Inflation, though, that's the biggest wild card.
Stay.
Still, while service inflation is stabilizing and housing is cooling, the sources fear a potential shift in policy priorities. If the Fed starts prioritizing job protection over aggressively hitting that 2% inflation target.
It could create unexpected price stickiness.
Exactly. And that predictability we just talked about vanishes. But the overall trend remains favorable.
Okay, so we have a moderate, stable foundation. That means capital can flow confidently into the big disruptive trends. If the macro is the steady floor, then AI has to be the explosive rocket ship sitting on top of it.
Absolutely. The market opportunity for 2026 really consolidates under one massive physical theme: AI infrastructure and resource constraint. The key takeaway from the reports is that the ceiling on AI growth is no longer chips or software. It's physical energy supply.
Why power? Of all things. I mean, we think of AI as this digital construct.
But it has a massive physical footprint. A single large AI data center, and we are building hundreds, consumes as much electricity as a mid-sized city.
Wow.
The sources project that this demand alone will drive a staggering 25% jump in U.S. electricity demand by 2030 and 75% by 2050.
That's a generational infrastructure rebuild.
A multi-trillion-dollar one. That puts the entire investment discussion into the physical world.
Okay, so here's where it gets really interesting. How do we solve the power crisis?
We need two things: massive reliable sources that run 24/7 and quick scalable deployment. The reports all point to nuclear and solar as the two essential answers.
Let's start with nuclear.
Right. First, nuclear energy is the baseload answer. Nuclear plants operate at an unparalleled capacity factor, over 93%.
Which makes them, what, 2 or 3 times more reliable than wind or solar?
2.5 to 3.5 times, yeah. So the U.S. government wants to quadruple capacity by 2050, but AI hyperscalers like Microsoft and Meta, they aren't waiting. They're signing huge 20-year power deals right now.
That is such a direct, quantifiable link between the AI boom and traditional power. So who's best positioned for that?
The largest U.S. operator, Constellation Energy, or CE, is a key focus. They directly benefit from those deals, which lock in revenue for decades. And crucially, the reports note their earnings have a firm floor thanks to the government's nuclear production tax credit.
So that protects their downside.
Substantially. Then you look at the next-gen tech. GE Vernova, GEV, is deeply involved in building SMRs.
SMRs, for the listener who might not be deep in energy jargon, are small modular reactors. What makes them so transformative?
They're standardized, factory-built nuclear units. You can transport them, install them relatively quickly, often on old coal plant sites. They basically democratize nuclear power.
And GEV is a big player there.
A huge player. They're forecasted to more than double adjusted earnings between 2024 and 2026 as this scales. We also see companies like the UK-based Rolls-Royce around CEY applying its nuclear submarine expertise to develop its own SMRs.
So nuclear is the long-term, high-reliability bet. What's the rapid response solution?
That's solar energy. Unlike nuclear, which takes a decade, solar can be deployed fast, and the economics have fundamentally changed.
How so?
Photovoltaic panel costs are down 90%. And this is critical. Massive scale battery costs have also plummeted by 90% to about $115 per kilowatt hour. Storage parity is the game changer.
Because when you couple solar with cheap, massive storage,
It can deliver stable, 247 power. It becomes a viable option for AI's round-the-clock needs.
and the scale required is just mind-boggling.
It is. The current U.S. solar fleet would need to triple or even quadruple just to meet the data center power needs by 2030. We're talking about building utility-scale solar farms at an unprecedented rate.
So who are the plays there?
Well, reports highlight companies like SolarEdge, SEDG, which is moving away from the volatile residential market into large utility-scale projects, and also Shoals Technologies Group, SHLS, which focuses on the overlooked stuff, the balance of system components like wiring and connectors.
The shovel sellers.
The ultimate shovel sellers. They profit from every new solar farm, regardless of who makes the panel.
And finally, we can't forget the resource metals to wire all this together.
Absolutely not. Grid upgrades alone are predicted to cause a global copper supply gap of 600,000 tons in 2026. Copper is the metal of electrification.
And lithium.
Lithium demand is shifting. It's not just an EV story anymore. It's now a massive grid energy storage story.
Okay, so that whole conversation is about powering AI's brain. Let's pivot to AI's body, the actual physical output of this broom.
The key theme here is the rise of humanoid robotics. The industry is crossing a major commercial threshold.
Threshold in what way?
Predictions show volumes surpassing 50,000 units in 2026. That's over 700% growth. This is the moment robotics shifts from, a cool experiment to essential commercial logic.
And the most cited example here is the Tesla Optimus robot.
Right. The analysis notes the goal for Optimus is mass production in 2026, targeting a cost of around $20,000 per unit.
And that number, $20,000, is the key.
That's the key, because that's the moment this stops being a fascinating project and starts becoming the new ROI benchmark for every factory boss in the world.
Because $20,000 is less than a typical U.S. blue-collar worker's half-year salary.
It's pure economics. But this brings us to a critical strategy in the sources. Risk mitigation. Betting everything on one high-profile entity, like one robot maker, creates a huge single point of failure. The reports call it idiosyncratic risk.
Idiosyncratic risk, just a fancy way of saying single company failure risk. If that one star stumbles, the whole investment crumbles.
And this risk is amplified in visionary sectors like space. The anticipated IPO of a huge integrated launch service, potentially valued at what, 1.5 to 2.5 trillion dollars?
Carries enormous valuation risk. You're pricing in perfection.
Exactly. So the actionable strategy is clear: de-risk. Shift focus from the end product producers to the diversified supply chain enablers, the shovel sellers again.
Right. So for robotics, don't just bet on the company making the robot.
Instead, focus on industrial automation suppliers, factory integrators. Firms like Rockwell Automation are okay. Their business thrives on general automation spending, regardless of who wins. They are the essential link.
And we apply this to the space economy, too.
We do. Instead of banking on that single massive IPO, you focus on companies like Rocket Lab, RKLB, which handles smaller payloads, or Redwire, RDW, in orbital systems. They benefit from the whole infrastructure build-out without that crushing valuation risk.
Okay, finally, we have to talk about defending all this new infrastructure. The nuclear plants, the solar farms, the automated factories.
Right, cybersecurity. It's the fifth major theme, and it's really the third pillar of the AI revolution, right alongside chips and energy.
And generative AI has evolved the threat.
Dramatically. Hackers can now create large-scale attacks, thousands of code variants, in seconds. Traditional defenses just can't keep up.
So the defense has to be automated.
It has to be automated and AI-driven. This requires sophisticated platforms that offer autonomous threat detection. It really shines a spotlight on leaders like CrowdStrike, CRWD, and Palo Alto Networks, PAN-W.
So that brings us to a pretty clear investment blueprint for 2026. A moderate, predictable macro environment lets capital flow confidently into the disruptive trends driven by that AI energy constraint.
That's it. Stability underpins the growth, but infrastructure is where the money is made. So to synthesize this entire deep dive for you, here is the short, easy-to-learn lesson based on everything we've covered, broken down into what to know and what to apply. So first, the key ideas. What to know. 1. Stability is the catalyst. Predictable policy with rates stabilizing near 3% actively encourages long-term capital allocation into those rate-sensitive sectors.
Like small caps and infrastructure.
Exactly. 2. AI's ceiling is energy. The massive power demand from data centers is the core constraint. That makes energy producers, nuclear SMRs, utility-scale solar, and resource suppliers the fundamental plays.
And third,
Prioritize the shovel sellers. High conviction plays in AI and space carry significant single entity risk. So you diversify by investing in the enabling infrastructure, the supply chain integrators that profit no matter who wins.
okay, so those are the ideas. What about practical actions?
Practical actions, what to apply. 1, expand capital allocation. Use that macro predictability to increase investment into broad, smaller cap index funds like IWM and biotech ETFs like XBI. They're highly sensitive to lower stable borrowing costs.
Makes sense.
And 2, focus on infrastructure execution. When you're evaluating AI opportunities, prioritize companies addressing the physical demands energy, SMRs, solar components, and security over the speculative, pure software bets.
Fantastic. And finally, two reflection questions for you to mull over as you think about applying all this.
First question. If the Federal Reserve unexpectedly hiked rates in 2026, which thematic sector we discussed, biotech or nuclear power, would likely suffer the most, and why? And second, the macro environment is supportive but not impetus. What is the single biggest catalyst that turns this predictable environment into a strategy for growth?
That's a fantastic framework. I think the great lesson of this deep dive is that the real profit is often found not in the revolution itself, but in the infrastructure that makes the revolution possible. Secure the foundation, and the growth will follow.